Welcome back to Investing Talk Podcast.
It's good to be here. Today, we're looking at a sector that usually screams risk to most investors. We're talking about space.
Oh, boy.
But we aren't talking about, billionaires trying to colonize Mars or the flashy rockets exploding on the launch pad.
Right.
We are looking at a company that is doing something much more pragmatic and honestly much more interesting from a numbers perspective. We are diving into Redwire.
As usual, before we start, subscribe, like, and comment to this video to support the show. Okay, let's get into this. So when I think of space stocks, I usually think high volatility, massive cash incineration, and, dreams that are 10 years away. You're telling me Redwire is different?
It is fundamentally different. I mean, think about the space industry right now as the California gold rush of the 1840s.
About.
Companies like SpaceX or Rocket Lab, they're the prospectors. They're hiking up the mountain trying to find that gold nugget. High risk, high reward.
Sure.
Redwire is the guy at the bottom of the mountain selling the pickaxes, the shovels, and the denim jeans.
Ah, the classic picks and shovels play. I like that analogy because historically, the people selling the shovels made money whether the prospectors found gold or not.
Exactly. They are an infrastructure company. They build the power systems, the navigation sensors, the docking mechanisms, the kind of boring, critical stuff that every single mission needs to survive in orbit. And while the market has been obsessing over who launches the rockets, Redwire has been quietly cornering the market on what goes inside the rockets.
That sounds great conceptually, but quietly doesn't usually pay the bills.
Is the market actually noticing this? Because, infrastructure plays are usually slow movers.
They're waking up to it right now. If you look at the last few weeks, specifically since the end of 2025, the stock is up nearly 50%.
50% in just a few weeks. That is a massive move. That is not a boring infrastructure move.
It is a violent move to the upside, and it's backed by a real shift in their business model. They're moving from being a fragmented R&D shop, basically a collection of science experiments, into a cohesive industrial-scale manufacturer. Okay.
But the real so what here isn't just the stock price. It's where they're winning. While everyone watches NASA, Redwire is quietly dominating the European market.
Okay, hold on. I want to get to Europe. That sounds like a specific edge, but first I need to play the skeptic.
Go for it.
You mentioned a 50% stock move, which is great, but let's look at the actual business fundamentals, because I've seen plenty of these space SPACs fly high and then crash to zero because the math just didn't work.
That's a fair scar to have. The spaceback era was brutal.
So I'm looking at the Q3 2025 numbers. On the top line, the story looks fantastic. Revenue came in at $103.4 million. Yep. That is a 50.7% increase year over year. I can't argue with that growth. It's objective, and it's accelerating.
It's massive growth. And importantly, it's organic growth mixed with some smart acquisitions.
But, and this is a massive but, we have to talk about the bottom line. In that same quarter where they made over $100 million in revenue, they posted a net loss of $41.2 million. And if I zoom out to the trailing 12 months, the net loss is negative $268 million.
That's an ugly number on the surface.
It's a terrifying number. They are burning cash at an alarming rate. And when I look at their liquidity cash in the bank, plus their credit lines, they have about $89.3 million. You do the math. If you burn over $200 million a year and you only have $90 million in the bank, that runway looks very short. How do you reconcile that?
You're right to look at the burn, but you have to contextualize it. This isn't money being set on fire for marketing or parties. It's largely capital expenditure, CapEx, and integration costs. They're building the factories and the production lines to service their contracts.
Okay.
But the number that counters the fear for me is the backlog. We're looking at a contracted backlog of $355.6 million.
Okay, define backlog for me. Is this, we hope to get this money, or we have a signed contract? Because some companies play fast and loose with that term.
No, this is signed, sealed, and delivered. This is work that customers have legally committed to paying for. It's not a pipeline of potential deals. It's a backlog of obligations. And the reason they can lock that in is because of their moat. They have sticky technology.
Give me a concrete example. What do they make that's so indispensable?
Let's look at docking. Redwire basically owns the IBDM, the International Berthing and Docking Mechanism.
That is a mouthful.
It is, but think of it as the USB port for space. If you want your spacecraft to dock with the International Space Station or the future Lunar Gateway, you need a standardized port.
Right.
You can't just drill a hole and hope it fits. Redwire owns that standard. They just signed an 8-figure deal with the exploration company for their next spacecraft. If you're building a ship, you're not going to invent your own docking port. You're going to buy Redwires because you know it works.
So they are the universal connector that creates lock-in. Once you design your ship with their port, you're not ripping it out.
Precisely. It becomes part of the architecture. Then you have the power side. They're building the ROS rollout solar arrays.
ROSAs?
Yeah, these aren't the rigid solar panels on your roof. These are flexible blankets of solar cells that roll out like a yoga mat, but they're the size of a football end zone. They are powering the NASA Gateway, which is the space station that will orbit the moon.
Okay, the tech is cool. I'll give you that. Yoga mat solar panels for the moon is a pretty good pitch. But you also mentioned they're doing things outside of space.
Yes, and this is the diversification angle, which is critical for mitigating risk. Remember their acquisition of Edge Autonomy?
Vaguely.
They make uncrewed aerial systems, high-end drones. This connects Redwire directly to the defense budget. They're selling to NATO and the U.S. military. So if the civilian space sector has a slow quarter or NASA delays a launch, they have the steady drip of defense spending to keep the lights on.
That is a smart hedge. Defense spending is usually recession-proof. But let's go back to what you teased in the intro, Europe. Why is a U.S. company winning in Europe? Usually that market is incredibly protectionist.
That is exactly why this is the hidden gem of the whole thesis. Redwire has managed to embed itself as a local entity. Their European revenue grew 117% year over year.
Wait, 117%?
Right. It's now over half of their total sales.
Half their sales coming from Europe. That's staggering for a U.S.-based company.
It is. And you have to understand the geopolitics here. Europe is terrified of relying solely on SpaceX and American launch providers. They want their own sovereign capabilities.
Sure, they want to build their own stuff.
Right. And because Redwire has established a massive footprint there, employing European engineers building in European factories, they are viewed as a local prime contractor for the European Space Agency, the ESA. They're bypassing the Buy American friction that kills most other companies.
That's a significant strategic advantage. It's like a Trojan horse, but in a good way. They're technically American, but operationally European.
Exactly. They're riding the wave of European space independence, and that market is growing faster than the U.S. market in some specific sectors right now.
All right, I'm starting to see the growth story. And I will admit, looking at the balance sheet again, despite that scary cash burn, their debt levels aren't fatal yet. Their debt-to-equity ratio is 0.21.
Which is shockingly low for a growth company.
It is. It implies they aren't over-leveraged yet. They have room to borrow if they need to, which buys them time. But the clock is definitely ticking. Most analysts don't see them turning a profit until late 2026 or 2027.
Right.
They have to survive the desert to get to the oasis.
They do. But with the backlog and the defense contracts, the market seems to believe they'll make it.
Well, let's pivot to the charts and see if the price action matches the growth story. Because usually, if a company is burning cash like this, the chart looks like a disaster. Is that what we're seeing?
Quite the opposite. The price action is, well, it's voting with its wallet, and it's voting yes. We saw a textbook breakout. The stock went from about $7.60 at the end of 2025 to over $11 by mid-January 2026.
And that wasn't a straight shot up, right?
Yeah.
It had to fight through some ceilings.
Definitely. It smashed through resistance at $8, then $8.50. Those were levels where sellers used to step in, but this time the buyers just overwhelmed them. And context is key here. We're recovering from a 52-week low of $4.87.
So the trend has completely reversed.
Completely, but we are still far off the highs.
Right.
The 52-week high is $26.66. So even with this huge rally, we're nowhere near the historical peak. That suggests there's a lot of overhead space, no pun intended, for the stock to run.
What about the volume? Is this just retail traders getting excited, or is there real money moving this? Because low-volume rallies are usually fake-outs.
This is the most bullish part of the chart for me. We're seeing days with 44 million shares traded.
44 million?
Even on quiet days, we're seeing spikes of 4 or 5 million. You don't get that many shares changing hands just from retail traders on their phones. That is institutional accumulation. That's the big money-taking positions.
And looking at the moving averages, I see we just crossed the 60-day, and we're closing in on a golden cross. For anyone listening who isn't a technical analyst, Can you explain why that matters?
Sure. A golden cross is when the short-term average price, the 50-day crosses above the long-term average, the 200-day. It's a lagging indicator, but in the trading world, it's seen as a major signal of a trend reversal. It signals that the long-term bear market is officially over and a new bull market has begun.
It tells the algorithms to start buying.
Exactly. We are right on the doorstep of that happening.
However, I have to throw some cold water on this. The oscillators, things like the RSI and the CCI, are running very hot. The CCI specifically suggests we're overbought in the short term.
That's reasonable.
I mean, when a stock goes up 50% in 3 weeks, it usually needs to take a breather. I wouldn't be surprised to see a pullback here.
No, nothing goes up in a straight line. But look at the base it built. It formed this sort of cup-like recovery pattern before it launched past 840. That tells me there's a floor of support. If it pulls back, there are buyers waiting.
Okay, so the charts are hot, but charts can lie. Let's look at sentiment. The humans. I pulled the data from Alpha Vantage, and the new sentiment is overwhelmingly positive. 71% of recent headlines are classified as bullish.
That matches what I'm seeing in the industry press.
We're seeing headlines like Redwire powering NASA's Gateway and Redwire leads with new contracts in Europe. The media loves an infrastructure play right now because it feels safer than a rocket launch that might just, explode.
It's a tangible narrative. It's easier to sell we build the solar panels than we might get to Mars in 10 years.
But what about the Wall Street analysts? The people paid to crunch the numbers.
They're on board. We have a consensus where 7 out of 10 analysts have a buy rating. But the price targets are the really interesting part. The average target is $17.21.
And we're trading at 11. So they think there's another, 60% upside?
Even more. That implies about a 115% upside from where the breakout started. You have H.C. Wainwright sitting there with a $22 target. That's a double from here.
Are there any bears in that camp?
Not explicit bears, but cautious bulls. Cantor Fitzgerald lowered their target to $9, but they kept an over 8 rating. That tells me they like the company, they like the stock, but they're worried about the timeline. They're hedging on when the value unlocks, not if.
Okay, so the analysts are buying it, the institutions are buying it, but let's look at the people inside the building, because this is where things get messy, and this is where my alarm bells start ringing.
It is a bit of a mixed signal, I'll admit.
On one hand, you have the CEO, Peter Canito. He bought about 32,000 shares back in November 2025 at around $6. Timed the bottom perfectly. That is a massive vote of confidence.
It's always good to see the captain buying shares of his own ship.
But then we have the elephant in the room. The private equity firm, AE Industrial Partners, they're the major backers. And between January 13th and 14th, 2026, they sold 14.3 million shares.
That's a massive block of stock.
It is approximately $150 million worth of stock. They dumped it right into this rally. Now, I have to ask, if this company is going to the moon, why is the smartest money in the room cashing out? That looks like an exit.
It definitely raises eyebrows, but you have to understand how private equity works. AE Industrial has been in this investment for a long time. Their business model isn't hold forever. It's to buy companies, fix them up, and eventually return cash to their own investors.
So it's just portfolio rebalancing.
I think so. They're taking some chips off the table. It's not a total liquidation. They still hold a massive position. And here's the proof. The stock actually rallied after the disclosure.
That is counterintuitive. Usually when a big holder sells, the price tanks.
Exactly. But in this case, the market absorbed that $150 million of selling and asked for seconds. The stock went up 12% after the news broke. That shows incredible demand.
Wow, okay. That is a very bullish signal on liquidity. But let's stay on the risks. We have to address that massive sell-off, so let's look at the other risks.
Okay, hit me with the bear case.
It's the contracts themselves. These are largely fixed-price contracts. In Q3, they had negative margins, partly due to EAC changes, that's estimate at completion.
Let's unpack that.
In plain English, imagine you hire a contractor to build a kitchen for $10,000. He gets halfway through and realizes the wood costs double what he thought. If he has a fixed-price contract, he has to eat that cost.
Right, he loses money on the job.
That's an EAC adjustment. Redwire realized some of their satellites cost more to build than they planned. And if they keep having those adjustments, that profitability in 2027 is going to keep pushing further out.
That is a fair concern. They need to execute better on the manufacturing side.
And then there's the financing risk. Analysts are suggesting they will need to raise more cash in 2026. If the stock price dips back down to $5 or $6, and they have to issue new shares to raise money, well, they're going to dilute the current shareholders.
Dilution is the enemy of the early investor for sure. If they issue more shares, your slice of the pie gets smaller.
Exactly. And finally, valuation. Based on current cash flow, the stock is technically worth, well, almost nothing because the cash flow is negative. The entire valuation is based on future perfection.
That's true. You are paying for 2027 and 2028 today. If you're a value investor looking for dividends and safe cash flow, run away. This is not for you. This is a growth story.
So we've weighed the massive growth against the cash burn. It's time for the verdict.
That sums it up.
Where do you land on Redwire?
I've gone back and forth on this because the cash burn does worry me. But when I look at the strategic positioning, I'm giving this a bullish score of 8 out of 10.
An 8. That's high confidence given the risks we just discussed.
It is high, and here's why. Redwire is becoming the infrastructure backbone. They aren't gambling on one rocket working. They have a $355 million backlog of signed work. They have the critical IP, and most importantly, that European expansion is a defensive moat that their competitors simply do not have.
So you think the picks and shovels narrative outweighs the cash burn?
I do, because the space economy is real and it is growing. Someone has to build the infrastructure. And right now, Redwire is the one building it.
What should we be watching for in the next few months to confirm your thesis?
The catalyst calendar is pretty clear. Watch for Q4 earnings on March 9th, 2026. We need to see if that revenue growth holds up. And look for updates on the NASA Gateway in Q1. If they deliver those solar arrays on time, it validates their engineering.
And how would you play this? Is this a buy now or wait?
This is not a day trade. This is a multi-year hold, 12 to 24 months. As for entry, the stock is hot. I would be an aggressive buyer on pullbacks. If it dips to $9 or $10, grab it. The analyst target is 17 plus, and I think the fundamentals justify that.
All right. I'm still skeptical about the financing. I hate seeing companies burn cash like this. But I cannot deny the backlog or the European success. If they can navigate the next 18 months without diluting shareholders into oblivion, the upside is clearly there.
It's a high-risk, high-reward play, but the pieces are on the board.
Well, you heard it here first. Redwire is building the road to space, and business is booming, even if the bank account is leaking a bit. Keep a close eye on those earnings reports. Make sure you subscribe for more deep market analysis. We'll see you in the next one.
And here's a thought to leave you with. Everyone talks about mining asteroids or living on Mars, but before any of that happens, someone has to build the gas stations, the parking lots, and the toll booths. What happens if Redwire becomes the only company that knows how to build the parking lots in space? Think about that monopoly power.
Now that is a scary and profitable thought. See you next time.